Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis, Wiley, and Alan Wallace.
Hello, and welcome to today's episode of The Point. I'm your host, Landis Wiley, sitting here as always with Chief Investment Officer Alan Wallace.
Hello.
Alan, how you doing?
Doing great.
You excited for this?
Fall is here.
Fall is here.
Football's in full swing. It's great.
It is. Hawkeyes are doing okay.
Yeah, well, what do you expect?
Yeah. So, I don't know. Always an exciting time of year. Bears are doing good.
I know.
Cubs lost. They're not in the playoffs anymore. So
All the Chiefs fan in the office are starting to panic a little bit, but, we'll see how it goes.
Yeah, well, I'm sure the refs will take care of that. So
Yeah.
it'll be okay. So, well, thanks for tuning in today. As always, we hope that this will be enlightening as we sort of work our way through a financial topic of interest that's going on out there. So our opening segment, though, important things that are happening in the financial world.
Mm-hmm.
There's been a lot going on. Recent episodes.
It's hard to narrow it down to just one.
Harder to narrow it down. But I think a timely one that's out there was just in the past week. There was quite the little, we'll call it market hiccup, flash crash, scary moment, lots of red headlines, whatever you want to call it.
They call it a washout.
A washout, yeah. Heavily hit the crypto markets,
Right.
But wasn't entirely confined to the crypto markets either. It did spill over into some of the broader stock indices and what have you. So, that drew a lot of attention. And given that it was on a Friday, a lot of angst for people over the weekend, wondering what was going on. So, a lot of headlines around it. So let's talk about it. What happened?
Well, so leverage has been building up in the crypto markets. And they'd gotten to the 10 to 1 levered mark, which means that you put 10 cents in for every dollar worth of assets that you own, right? So a 10% decline basically wipes out all of your equity. Mm-hmm. And that happened to a lot of people. I read somewhere over 1 million accounts were completely wiped out. That may or may not be true. Usually during something like this, the news is a little bit spurious as far as whether it's true or not. So by the time this airs, we may find that some of the things did happen that we think happened. But million accounts taken down to zero. All the stop orders were sort of wiped out. A stop order is when you put an order in advance that if the price goes below this, you sell. Well, the problem is that there's no limit on the downside. So if something drops 80%, you basically get, 20% of what your value was the day before. And when you're levered 10 to 1, that means that you now have a bill or a liability instead of an asset.
Right.
And, there was a lot of talk online about people losing, millions of dollars.
Right. So these weren't small accounts.
No, the biggest one I saw that got completely wiped was 19 million.
Wow.
So now it's likely that most of that money was made in the last year or two. So it's not like old money got wiped out. They say easy come, easy go. Right. But then, Monday rolls around. Monday's a holiday, so all the bond markets and banks are closed. And then, today is Tuesday. And so we're still kind of waiting to see if any of the lenders get margin calls of their own, right? Because when you get wiped, that means, someone lent you that money.
Right.
And if that lender took losses as well, then that's something that we need to be concerned about because, credit losses aren't normally contained. Our system is a patchwork of people lending money to each other. The problem is if the same dollar is lent 12 times and then the end user loses that dollar, the entire dozen get wiped, right? Mm-hmm. And so that's how credit risk and credit defaults sort of spread. So remains to be seen whether the crash builds speed, whether any of the lenders go under. I did see a couple of the companies that run these exchanges got wiped as well. So again, we're not interested in the activity of the crypto market as much as we're concerned with any sort of contagion that spills over into any markets that we're operating in. And because we have such low credit risk, it doesn't look like there's anything that's going to impact us at this point, but we'll always be diligent and we'll keep our eye on it.
Right. So when you talk about, you use the term leverage and you use the term default in credit market, that may be giving some people a little bit of PTSD back to 08, 09.
Sure.
Right.
Yeah, but the difference was that was the mortgage market itself. Mm-hmm. In this case, we're just talking about the margin markets for cryptocurrency, right? So much smaller market. The initial reports I saw said that there was about 20 billion in total losses. So not tiny,
right?
But nothing compared to the mortgage market.
Right. So how does that, we've talked about it in prior episodes, because we've had questions from viewers about cryptocurrency and specifically Bitcoin and things like that. And should they be putting it in portfolios? So when you see these types of crashes, which this isn't the first time this has happened.
The last time was 2021.
Right.
But it wasn't nearly this bad.
Right. So, as these things happen, what would you tell a person out there who's, sitting and saying, well, what does this mean for Bitcoin and cryptocurrencies in general? And there's been headlines. We've talked about this, about a push to allow cryptocurrencies into ETFs and potentially into retirement plans and 401k plans and what have you. So how do these types of events potentially impact some of those conversations or thoughts from investors?
Well, they don't make me any more likely to want to invest in it. So the problem is that the cryptocurrencies don't have their own cash flows. Any investment that you hold is just a series of cash flows, and whether that is earnings or dividends or interest or whatever, the things that we invest in can be valued because we can determine what the rate of return is based on the cash flow it's yielding. The problem with crypto markets is there is no cash flow. Actually, there's two cash flows. There's when you buy it and there's when you sell it to someone else, right? So we have no third point to triangulate what a value should be. And so that means that the value is based on psychology. And when you buy assets based on psychology, you're really the victim of all your fellow owners.
Sure.
And if your fellow owners own this at 10 times leverage, then they don't have the option of waiting it out. Patience cannot overcome leverage. That's the problem, right? And if you go back to the Great Crash of 1929, that was mostly caused by leverage. And I think people miss that point that, during 1920, the crash of 1929, they were levered 10 to 1, just like in this case with cryptocurrency. Right. Now you can only lever it 2 to 1.
Sure.
Based on Federal Reserve guidelines. So that's why you really haven't had a crash like that since, because we've really taken a lot of the leverage out of the equity markets. Well, now, we have this going in the crypto markets. And I'm assuming that over time, the regulation will catch back up and put the crypto markets on par with the equity markets. Now, that may take some of the allure out for a lot of the people that are really just using this as a gambling mechanism.
Right. Yeah, because at that point, that unique unicorn asset class that is cryptocurrency starts to probably function and look a lot more like a standard asset class, right?
Right, exactly. And I think that takes some of the volatility out of it, which is what a lot of the people are involved for.
Yeah. That rush of seeing it double or triple.
If your knuckles are white while you're investing, you're doing it wrong.
Right.
So this is supposed to be really boring.
Yeah. Perfect. Okay, awesome. Well, be interested to see kind of how this plays out over the next couple of weeks. But with that, we'll be right back for our main segment with our viewer question.
Imagine having the peaceful rhythm of ocean waves as the soundtrack to your well-earned retirement. Helping make retirement dreams come true, Basepoint Wealth Fee-Only Advisors provide you with independent and transparent wealth management advice, because from here, you can go anywhere. Schedule a complimentary consultation with a Basepoint Wealth Advisor now at basepointwealth.com. Basepoint Wealth is a registered investment advisor. Visit basepointwealth.com for important disclosures.
All right. Well, welcome back to today's episode of The Point. Again, Landis, Wiley, Alan Wallace.
Hello.
We appreciate you joining us. We got a viewer question.
Okay.
So, and I know it's one that's actually been coming up more frequently with clients and advisor conversations around at Basepoint too. So, kind of timely. So, a little bit of context and a couple questions in here. So it said, I currently have a 6.5% mortgage, and I've been waiting to be able to refi. I think they must miss their old 3% probably. With the Fed finally cutting, I'm starting to see mortgage rates closer to 6%. At what point does it make sense to refinance a mortgage? And in general, where do you think rates are going from here?
Okay.
So kind of a personal question there, but I do think I was reading something here just in the past week that something around 30% of mortgages out there now are at rates over 6%,
right?
Which is a big change from where we were 2 years ago when we were talking about, well, nobody's going to refinance or nobody's going to move because who's going to give up their 2.5 or 3% mortgage?
Well, eventually you have no choice. So,
Right.
whether that's a job change or a death or a divorce, all those things, unfortunately, eventually get us all. It could be a 50-year time frame, but
Right.
I think that there are still a lot of people stuck in 3.5% mortgages.
Right. Yeah. Certainly anybody who has the choice to stay where they're going and,
Right.
doesn't have a big urge or a need to move, why would you?
Right.
So, interesting question though. So what is going on with rates right now? Because we have talked about interest rates in previous episodes.
Yeah.
We've talked about Fed policy in previous episodes. In September, the Fed did cut by
Right.
25 basis points or a quarter point. Expectation is coming up at their meeting later in October that they'll cut again.
Right.
A lot of debate on if they're too late in cutting rates.
Yeah. I mean, that's above my pay grade. So.
Right. So Fed seems to be indicating that it's going to move in the direction of cutting rates. Mortgage rates, though, don't seem to have really followed that trajectory.
Right.
If you look over the past month or so since the Fed did cut, they've remained relatively stable, below where they were, but they haven't necessarily moved maybe the way people would expect. So
Right.
you want to talk a little bit about this mechanic and how this works?
Yeah. So when the Fed talks about cutting rates, they're talking about overnight rates. So remember, interest rates are not a monolith. There's thousands of them, by time, by credit quality, by issuer, whether it's government, whether it's corporate. So there's one specific rate that they're cutting, and that is the overnight rate. Mm-hmm. So when you price a mortgage or an auto loan, or even sometimes a credit card loan, you're basing that on 10-year treasuries, not on overnight rates. So the important thing to remember is that the 10-year treasury is maturing 10 years in the future. Mm-hmm. That means that we don't know what the inflation is going to be over that period of time. So the 10-year treasury has an inflation premium built into it. And when you cut short-term rates, theoretically, you're stimulating the economy, which should cause economic activity to increase, which puts pressure on inflation. Mm-hmm. So your 10-year actually goes up in yield because your inflation premium is building up. There was this widespread strategy over the last 10 or 15 years to buy treasuries to capture the decay of the inflation premium, right? That sort of functioned like an inflation-adjusted bond. If anyone wants to have a really boring conversation, I can talk them through it, but I'll spare the average listener. But we talked to real money managers who were buying 10 years because of the decay mm-hmm. of the inflation premium. Well, now what we're seeing is as they're cutting rates, that inflation premium is starting to get built back up. Mm-hmm. And so that's causing mortgage rates to actually rise instead of fall, even though interest rates are declining. So I guess you have to pay attention to which rate you're talking about.
Right.
So,
and I think that caught people off guard in the fall of 2024,
right,
when the Fed came in and cut by, I believe, 0.5% at that point, and mortgage rates 3 months later were almost a full percentage point higher
right.
than what they were when they cut, and I think a lot of people were caught off guard by that.
That's called a steepening of the yield curve. That's what happens when we change interest rate regimes, mm-hmm. And so if inflation continues to be sticky, you'll probably see 10-year either be stable or continue to increase. Mm-hmm. And that's going to cause your mortgage rates to either stay stable or go up. I don't foresee that, those mortgage rates going down anytime soon based on the current inflation data. Mm-hmm. Now, obviously, weird things happen all the time.
Right.
But most of the bias right now is towards either sticky or increasing inflation. And then with short-term rates declining, that will put more pressure on the 10-year.
So what sorts of metrics, if the market is trying to guess where inflation's going and assuming that, hey, money's going to get cheaper, ideally to pick up economic growth, therefore inflation is going to be higher in the future. What types of metrics or data points or expectations of the market would maybe flip that around where people would say lower inflation than maybe what they're expecting right now? Recession.
Yeah.
Okay.
Yeah. So if we head into a recession, then typically that's going to reverse. Mm-hmm. You'll see, and that'll be demand based. So people will want to move out of risky assets into safe assets. Mm-hmm. So the more treasuries people buy, the more the rates drop, right? So the counter action to this would be, entering into a recession causing demand for treasuries to increase, causing the rates to drop. That'll cause mortgage rates to drop, which in essence will stimulate the economy a little bit.
So tied to that, one of the things that often sort of gets looked at alongside discussion of a recession is unemployment. We've seen that tick up just a hair, right? We've seen labor adjustments back in September.
The unemployment rate, yes, but when you look at jobs, that's been completely different, which is what the entire last podcast was about. So
right. So as you're looking at jobs, right now, one thing that's going on is government shutdown.
Right.
And there's more and more talk and more news cycle talk about, government workers. And there's a lot of them that are, receiving their last paychecks, at least until things reopen.
Right.
So what could the potential impact of that dynamic unfolding potentially have on, as we relate this back to, if inflation rates are a key component of the driver of the 10-year, which is the driver of mortgage rates, which is the premise of the question, how do some of the things that are happening kind of on the national level, whether it's government shutdown or the international level with some of the trade war tariff conversation, how does that maybe play into this if you're looking ahead over the next 3 to 6 to 12 months of maybe where that Treasury rate is headed?
So, first of all, I don't expect this to last 3 or 6 months. It really shouldn't. This is the 11th government shutdown of my lifetime. So they're not uncommon.
We still talk about them like they are, though.
I know, right? Like it's this big deal, but yeah, so 1 out of every 5 years is basically a government shutdown. So now typically the pressure will start to build once people are missing paychecks. The Department of War, newly named, retroly named, has recently said that they found the money for at least the next month's paychecks. Remains to be seen whether that's true or not. So they've sort of bought themselves 30 days. And then they've also put themselves in the position where, the other party has to, sort of speak out against paying soldiers. So it's really kind of a bad position to be put in. So we will see. A lot of the core functions of government are still running because they have mandatory spending. But your national parks are shut down. I believe the post office, parts of the post office,
we're talking about air traffic controllers,
that kind of. So important things. But I don't really have a prediction on how long it's going to last. It's basically a game of chicken, and whoever blinks first is going to lose. So we'll just have to sort of watch it unfold. But the longest shutdown is somewhere in the 35-day range. It's not exactly 35. I can't remember. But so it's about a month is how long these things typically last. So, and that's with the modern era. I don't know if there was one in the 1800s or something that I don't know about, but
But in the grand scheme of things, probably not lasting enough to where it's going to dramatically change expectations of, say, rate markets.
No, I don't think so. Typically, though, when we reopen, there will be a big surge in Treasury financing, right? Because the bills aren't getting paid.
Right.
So when we reopen, there will be a big issuance of treasuries in order to pay the bills that are sort of, not been paid over the previous 30 days.
Right. Okay. So thinking about, where rates are right now, hovering around that, say, 6%, right? And obviously that's very market dependent where people are at in the country. But at least around here, they seem to be hovering around 6%. So if a person's sitting there saying, I don't really know what's going on with mortgages. I know the Fed is cutting, but I don't know why mortgage rates aren't dropping. And, it seems like at least your assumption right now is based on the information that's known, those 10-year rates in particular may be more sticky than the Fed rate itself.
Yeah, when I build the probability outlook of it, most of the things are pointing towards stable to increasing.
Right.
But obviously it's probability based. So sometimes 2% probability things happen.
Right.
So it's not really a prediction. It's that, most of the weight is on the side of stable or increasing.
Right. So a person that's sitting on a 6.5% mortgage, if they can get 6, does it make sense for them to consider refinancing at that point?
Well,
what are the things that they need to look at, I guess?
Our listeners work with a wealth advisor who can help them make that calculation.
Right.
But the old rule of thumb is 2%. I've heard some people say it's 1% as a rule of thumb, but really it comes down to math. Current payment, new payment, closing costs. How long does it take for you to break even on the closing costs, right? I mean, so it's a pretty simple back of the envelope calculation. And then the other assumption you have to make is how long am I going to stay in this house?
Right.
You know, if you're moving in 2 years, it may not be worth the time or the trouble.
Mm-hmm.
If you plan on staying there for 30 years, then a much smaller, decrease could be beneficial for you. But I'd say you just have to run the numbers and also be patient, because I believe you can typically only refinance once a year. So,
right.
You don't want to refinance at 50 basis points and then have rates drop to 1.5, and then miss your opportunity for a really big refinance.
Right. Okay. Well, I think, it's probably one of those things, like you said, just sit down and do the math.
Right.
Figure out if it makes sense. But 0.5%, generally speaking, probably isn't going to trigger.
Yeah, it just depends on how long you're going to be in the house at that point. So if you're still going to be there for 25 years, then maybe it will. Right. But you also might be better off just being patient and, hoping for lower rates at some point.
Right. Okay, perfect. Well, hopefully that answers the question.
Yeah. Okay. All right.
Anything else we want to cover on interest rates? I mean, it's kind of...
Well, so, interest rates are sort of this big thing. And I mean, they're the most important thing in finance, right? Mm-hmm. Buffett has said that interest rates are like gravity on the price of assets. And, you can go back 5,000 years and study the history. There's actually a book called The History of Interest Rates by a guy named Sidney Homer, who worked at, I think, Morgan Stanley back in the day, when they just had smart people in the basement, and it's, the book is this thick and it's as boring as it sounds. But to go back and see what all the relationships between wars and famines and, and plagues and all these things with interest rates going all the way back to ancient Babylon, it's really fascinating. But for our average viewer, keep your eye on the 10-year,
right?
Because that's really what's pricing the things that are important to you. And interest rates typically travel in cycles. We had a sort of a 40-year decline in interest rates, and now we're starting to maybe scratch our way back into the increasing phase of that cycle. Right. Whether the cycle terminates as high as the last one, we have no idea, right? If you look at the 1982 to 85 sort of peak in interest rates, it really stands out on a chart.
Right.
Interest rates have been relatively flat for hundreds of years. And then we have this sort of giant mountain in the 80s where Paul Volcker came in and, tamed inflation. But it is a fascinating discussion, but I don't think it's something that our viewers need to, be concerned with.
Right. So you mentioned the kind of 40-year cycle.
Ish,
that we
yeah.
went through ish. When have you said we've kind of maybe transitioned to the other side, right? So generally declining to generally increasing. When would you say that started?
Within the last couple of years.
Okay.
I mean, I think that after COVID, when we started sending out stimulus money, is sort of when it felt like a line of demarcation where the bias started to be towards more inflation and slightly higher interest rates.
Okay. So, if we circle that back to, part of the question is where do you see rates going?
Right.
Right. I think people are typically thinking of stock market cycles that move in, 5 to 7 year, maybe 10-year cycles.
They're much longer than they used to be because of the Federal Reserve. But,
right.
If you go back to the early 1900s, they were basically 7-year cycles.
Sure.
So, but now they're closer to 15.
Right. But what you're talking about is interest rate cycles. It's not uncommon for them to last decades, right?
Yeah, like, half of someone's life.
Right.
I mean, but it's important to remember that there are, there's the main cycle, and then there are little cyclical cycles within there. So that doesn't mean rates will never go down again.
Right.
It just means that when you look at a chart in 30 or 40 years, you're going to see this bias towards the upside. But when you're living in the moment,
right,
it can
month by month. It's like stock market, right? Day by day or minute by minute, it could be up or down.
Right.
It doesn't, change the overarching direction that the market itself is moving.
Yeah. But also remember that our economy, up until the last 15 or so years, was much more banking dependent than it is now. So, now you've got all this money in private credit sort of superseding the banking market. So it sort of it remains to be seen how important some of these interest rates are anymore for the economy, because a lot of the transmission of funds isn't going through the banking system anymore, right? So when neoclassical economics was being, invented in the 1870s, everyone kept their money in the bank, right? And that's just not really how it is anymore. So I think we'll need to make some adjustments to some economic equations to make up for the fact that most of the transmission in the economy no longer happens through the banking system.
Interesting. Well, that sounds like a topic for a day.
Yeah, that's a different day.
Yeah. Perfect. All right. Well, hopefully some good advice for folks, and I think, we talk about it a lot with investment portfolio and decision-making, trying to time things to the exact moment.
Yeah. It's got to be about the math.
Right. So, in this case around mortgage rates, if you've got one, do the math, figure out if it makes sense. Patience may be the key.
Sure.
So,
yep.
So with that, again, appreciate you tuning in today. Like the viewer who sent the question in, if you've got a topic that you've heard about, read about, discussed with a friend, or just curious about, send it on in. Maybe we'll banter about it.
Sounds like fun.
So until next time, Landis, Wiley, Alan Wallace.
Thank you.
On behalf of Basepoint Wealth, take care.
Thank you for joining us for this episode of the Point Podcast, sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.